Great, Paul. Great to have you on the show. But obviously, your responsibility, or part of your responsibility at Stanlib, is managing your fund of funds suite that you run offshore. I wanted to just get a perspective. We've seen a fantastic run in the JSE last year, great run in Europe and the States. What's your sort of take on certainly equity valuations offshore and what you expect from them in 2013?
Equity valuations are not extended, even though we've had a great run. Because they were particularly undervalued probably 6 months ago, so they've caught up a bit, but they still quite a bit below the averages, the sort of average PE ratio of about 16 over the last 20, 30 years. So we're still looking at trading at about 13 times forward, and Europe even lower. Earnings expected for 2013, and they're very mediocre expectations for earnings for this year. I think Europe may be flat or even slightly down still, and the US may be up 5 or 6%, 7%, 2013. So valuations still look good, especially with the background of record low short-term rates and long-term rates.
Is the question, and I always ask this question, we see a great rally like that, very low economic environment in those countries as well. I think Europe's still in a recession, is the last time I saw, but the equity markets go up. We've had a massive amount of quantitative easing. Is that not the reason why those equity markets are rallying, or are we making progress on the global debt crisis?
Well, we're making progress in particular in the sense that the so-called tail risks, the risks that could really pull the carpet out from out of the economies of Europe, the US and China, those tail risks seem to have pretty reasonably evaporated. If you look at Spain having raised, I think, 4 billion euros yesterday at something like 3%, and that's a country that's seriously in trouble. So that's an illustration that it's a lot easier for countries like Spain to borrow money, and apparently investors bid for something like 4 times what Spain was looking for, and a lot of them were foreigners outside of Spain, wanting to buy Spanish 10-year bonds. So the risks of some catastrophe, a financial catastrophe in China, the US and Europe have dissipated quite a bit, and that's kind of released the spring for equities to go up. And then of course the other side of the coin is that equities are very much a leading indicator, and they are telling us that economies are going to be recovering because they run ahead 3 to 6 months. So we're already seeing the US showing quite a bit of resilience economically, turning. So that's the biggest economy. The second biggest economy, China, seems to be turning up. So these two of the biggest economies in the world are certainly going to spread. That good news factor is going to spread, and it's going to come here too. So our economy should pick up in a few months as well.
Now you're responsible for asset allocation across your funds. You get to choose how much of money, how much of the pie of the portfolio is allocated across different asset classes, fixed income, equities. What have you done in the last few months, or what do you intend to do, very shortly, around how you change the way you've allocated money in these portfolios that you manage?
I went very overweight equities in my offshore portfolios probably 8-9 months ago, and withstood a few knocks here and there, but it's come through very nicely, as you mentioned, in the last 4 or 5 months. So now I'm actually cutting back a bit of that overweight. I was underweight bonds and very overweight listed property, global listed property, which has outperformed equities since the crash. Outperformed last year, and has outperformed. In fact, the Stanlib Global Property Fund was up 30% last year in rand terms, and I think it was like 21% in dollars or something like that, or actually more, 25%. So I'm still keeping a very overweight in global listed property because it's a yield. There's a thirst or a hunger for yield out there, and you're still getting roughly 3.5% dividend yield out of global listed property, with the hope of increases to come. But equities I'm pulling back a bit just because the elastic's getting a bit stretched. And typically late January, February, it's quite common to get a bit of a pullback, and maybe the exuberance is building a bit. We're seeing huge flows coming into equities, into emerging market equities, which is very good, but at the same time it could be a sign that maybe we're in for a little bit of a correction. I wouldn't be surprised, put it that way. Put it this way, the odds of a correction are rising. The more people worry about the correction, the less chance it will actually happen. And there are lots of people worrying about it too. Because we did see the US stock market break out to a 5-year high literally last week. And I think the UK is pretty close to that. I think it has. Germany. So, from a chart point of view, that's a good sign.
Okay.
So, but I've pulled back to closer to neutral.
And just to get that right, you're pulling back from developed market equities as well as emerging market equities?
More so emerging market, because
more so?
Yeah, emerging market allocations are, as far as the benchmark goes, only 13% of the MSCI World Free Index. And I was sitting at about 26%, so I'm pulling that back to 20 or under 20%. So cutting a bit back more on emerging markets.
But emerging markets is an interesting topic. Or we're all familiar with the growth story in the BRICS and the new emergence of countries in the frontier markets or the horizon markets, whatever you choose to call it. Do you think South Africans in general have enough exposure to emerging market debt or equities?
No, I don't think so. I don't think South Africans have enough exposure to offshore because of the bad experience of the last 13 years when the rand has appreciated and hurt them, and where offshore markets are still trading where they were 12 years ago in dollar terms, so, and probably in rand terms too. So people are scared. Financial advisors and investors have been scared to go offshore because it's been a bad experience, and South Africa's done so well. And you get no interest on your money in cash over there and very little in bonds. So I think they are reinvested on the whole.
Okay. Just in terms of that, just in terms of this question around taking money offshore, you've mentioned some of the problems. That we've heard about the JSE being the best performing stock market over 100 years. We look back over the last decade and we see the incredible returns that we've enjoyed both in listed property and across the entire equity space. What's your sort of long-term expectation for the JSE going forward? Are we going to see the type of returns that we've seen, say, over the last 12 years, or should we get used to a lower return world? Drum down the expectations.
That's what all our competitors are saying. Look, it's it all comes down to what will the earnings be and where will the interest rates be. So I think we're looking for earnings growth in South Africa of give or take 15% this year, which is still pretty good going into the fourth and fifth year of the bull market. Actually, the fifth year starts on the 10th of March. So, I think there's a high probability that the offshore markets would outperform South Africa this year, because South Africa caught up very quickly late last year, and so did the rand. So the JSE in dollars was up 9% in December, and now it's given back. It's down 4% in dollars because the rand's taken a big smack. So, I think there's a fair chance because of money moving out of bonds offshore into equities, which is we've seen massive amounts of money going into bonds for the last 3 or 4 years, despite the equity market recovery offshore. And I think some of that's starting to come out and go into equities now. So there's more demand for equities offshore potentially than there is here. So I think it should outperform the local market in dollar terms this year.
In dollar terms, okay, great. You mentioned that you're underweight fixed income overseas.
Yes.
I guess it's a no-brainer to talk about the problems with holding fixed income in government bonds overseas, the low rates of interest, and obviously there was a very real and imminent threat to credit risk there. Is there any other assets in the fixed income space that have interested you aside from the listed property that you mentioned?
Well, the high yield bonds have been very interesting. They've almost outperformed equity since the bull market started on the 9th of March 2009. In fact, they have. High yield bonds, or so-called junk bonds, in the US and Europe, and even in the emerging markets, have outperformed equities in dollar terms. So it's a question of now they're just looking a bit too stretched. They're yielding under 6%, which, they may still have some more action to go, but I've cut back, sold the high yield bonds. They had a fantastic run.
When you say high yield, you're talking corporate debt?
Corporate high yield bonds that were yielding probably 8%, even 9% in Europe a year ago, and are now down in the US to under 6%. Actually, the European bonds beat the stock markets last year, the high yield bonds. So they've had a fantastic run. They're always the higher risk ones, but if you buy a portfolio, a unit trust of them, you've got a better chance. You're not relying on one or two or three. You've got a good portfolio professionally chosen by a fund manager. So that's been the most interesting one. And emerging market bonds have also done very well, even in dollar terms, in the past few years. So, I think that we've all been very surprised at how extended the bull market in bonds has become, because we might have thought it was a no-brainer 3 or 4 years ago to go underweight in bonds. but they've done better. They've done well every single year. So maybe this year will be the one year where, equities beat them quite handsomely.
Right. You're also a fund-of-fund manager. You use third-party investment managers for many of the portfolios. So you make the asset allocation calls, as I understand it, and then you farm that out to the stock pickers and as you mentioned, the guys to choose the bonds to invest in. I'm always interested to hear from a fund-of-fund manager like yourself about some of the traits that you look for in an investment manager, or some of the attributes you look for in an investment manager when you go and meet with, I'm sure, many of these guys. Are there any common threads there that you identify that are really important?
Well, I think if you look at the track record of a particular fund manager, if that fund manager is sticking very closely to the risk profile of the benchmark, you can perhaps hold that fund manager's fund as a core holding, and then you'll look for other more variable type of funds, like someone who has a more aggressive approach, who varies much more than the benchmark he or she is following, so that when you think equities are particularly good value, you want to own that fund, and vice versa, you want to be out of it, if you think there's going to be a sharp pullback. And then, it's a question of, really of which countries you're going to be going to. Like Europe was fantastically valued. The Stanlib European feeder fund did 31% last year in rand terms. So European equities had a tremendous run last year, despite all the issues that were around, for a lot of the year. And, I think some people still think there's good value there. But one huge positive that the US has going for it right now is that their natural gas prices are so low. They are incredibly low, which is giving. Now, I think the UK natural gas price is triple what the UK is, and Japan is 4 to 5 times the natural gas price. So this is giving American companies a huge competitive advantage where they're using natural gas for manufacturers and so on.
Nice.
And one of our fund managers offshore is seeing better value in American shares because of that.
So it's almost a sectoral theme, if you like, the low energy that manufacturing and heavy users of energy in the US have now because of the shale gas that's transforming the price of energy for them.
Exactly,
and
that fracking is playing a huge positive role in the US.
Right.
And hopefully we'll hear too one day.
Well, don't tell the Karoo farmers that.
Well, it's time they contributed to this country, the Karoo. It hasn't done much for many, many moons.